Can you hear me, Jared?
We
Okay.
can. We can. Where are you calling in from today, Roger?
Georgetown, Texas, about 30 miles north of Austin. I moved there in 2023 to be closer to my sister and things like that. So it's been about 37 years in California. So I'm
You
going to
love it.
let's see if we can
Yeah.
get going on sharing
Yeah.
this.
Looks
Yeah,
good. Roger and I met. We were how many years did you facilitate for the Ranching for Profit School? Maybe
23 now.
do you
So
still help them out occasionally, or are
yeah,
you officially
yeah,
retired?
yeah, I
Okay.
did.
Yeah.
Something like that. So
Yeah, you've been involved with them about as long as I have then, since the early 2000s. So
yeah.
I went to my first Ranching for Profit school in 2023 and met Roger at some of the events, and he just has a wealth of knowledge, as a great educator, and so I encourage you guys to sit up, take notes, um, be really focused on asking that question: what is my next step? What are the things that I need to do to be able to move my business and myself forward, and make note of that. So let's roll with it, Roger.
Okay. One of the things I'm kind of humbled to be on here. I listened to David Cole earlier today, and Selena characterized it perfectly. It was like drinking from a fire hose, but man, that was a tremendous presentation. I look forward to when that's gets put together and posted. I think I'm going to have to listen to that two or three times to
Oh
begin to
yeah.
get everything down. So if that was the graduate class, I'm kind of the elementary school teacher here, but we'll press forward. And there's going to be a little bit of repetition over what kind of Jared was just talking about and what I'll talk about. But I'm going to talk about keys to staying on track on profitability, on your profitability path, and what to do when you lose sight and get lost on that. So let's see if I can figure out how to advance slides. Did that advance there? Can you see that, Jared? Okay.
Yes, yep, it looks good, Roger.
So just a little background about me. I worked as a farm advisor with UC Cooperative Extension for over 31 years. I was in the sheep business for 15 years. I've attended four ranching for profit schools. The first one was in 1989. I turned 71 a couple of weeks ago. So that was actually 36 years ago. So that kind of ages you and stuff. I've facilitated with their Executive Link program, which is sort of their after support program through Ranching for Profit for 23 years. And want to really emphasize that my understanding of economics and finance is really coming directly from Ranching for Profit. There may be many other places you could go to find information, but that's where I am grounded, and that's, kind of where I will sit. One of the things that I did want to just let you know about, I mean, there's just listening to all the stuff that Jared and Selena are attempting to do, and they've been doing it for 8 years, which is really fantastic. So there is one resource for you to start moving your business forward. Another resource for you to start moving your business forward is the Ranching for Profit School, and there's Ranching for Profit. And at that school, this sentence right here, I definitely agree with as far as being able to transform your ranch in 1 week at the Ranching for Profit School. And I think the reason why that happens is it's a lot of short lectures. You're working in groups, a lot of group participation. You're looking at real world numbers and those types of things. You've got daily homework, and you've even got coaches that can help you start getting started on your economic analysis throughout the school. If you go to the website, you can find out when schools are happening. There's a couple happening pretty soon in Phoenix and Abilene, so that's just kind of there for you. One of the things that I will be talking about a little bit, for example, would be like the three secrets of profitability, but there's not time to get into the depth that is needed. So a couple of little things I wanted to point out. Ranching for Profit does have a YouTube channel, and if you go on there and either just try to search for it or this "What Do the Numbers Mean?" Dave Pratt did that. Do a search on that, and that'll give you a deeper dive on the three secrets of profitability. And I think right at the end of September, Jared had Dallas Mount on, and he kind of built on those three secrets of profitability and then took that into some practical applications and talking about key performance indicators and those types of things. And so that'll give you even more depth that I think would be some good support things for you to view. Now, I'm going to talk about types of business analysis. So here are a couple of types. One would be, you have your pile of receipts that you drop on your bookkeeper's desk or your accountant's desk, or maybe you're super organized and you put those in an envelope or maybe even a couple of envelopes and let them do that. Then from there, they're going to give you kind of just a laundry list of here is income and here's expenses, and kind of from a tax basis, here's the total income minus expenses, which would be like $4,100 worth of profit. And then we can ask that question, what is profit for? What is profit? And so just like we saw, some people might view that as income minus expenses is going to equal profit. So let's call back up what I had before. And the questions that we've got to ask ourselves are this. So here we've got, there's the profit. But the thing is, it's all income money. So for example, how do I count for the value if I retain heifers? And so we've got to look at that inventory value as far as what we're looking at there as well. And then also, let's see if I can get that to go. There we go. And do all expenses involve cash? That's, for example, what about depreciation on equipment? So income minus expenses is probably missing the mark a little bit. Another way to look at it is how would your banker define profit? And they're going to look at your balance sheet at the start of the year and your balance sheet at the end of the year. And they're going to look and see if you had an increase in net worth. They're going to look at assets minus liability. What is your net worth? Is your business worth more at the end of the year? Well, you could have a thing where you have assets that are rapidly appreciating, far exceeding what your liability is. So your balance sheet might show you as a profit. For example, think land, or even how quickly the value on cattle is increasing right now, type of a thing. But it might be from the actual business standpoint that you're losing money. So again, if we want to define profit this way, we still might be missing the mark. And then the other way would be looking at it, if you're looking at it from the concept of the Ranching for Profit School, the definition that they're using is from the value you produce, and that's your gross product, could you pay cash rent for the land, the full cost of labor, interest on all assets used, and all other production costs, and still make a good return on your investments. And you'll notice I've got three things highlighted in red here. So if you own the land, you'll still get charged an opportunity rent. That's a non-cash cost. You're not physically paying that, but that is to get it on an apples to apples basis with other businesses. Also, if you have a business that really has very, very low labor, they'll look at what really should be the expected labor costs there. And so they'll charge an unpaid labor there. And then looking at, say, your beginning inventory value of your cattle, demanding return on that, they'll also have an opportunity interest. The other non-cash cost that'll be included in there is also depreciation. So kind of going through that. So some steps to be thinking about. How is your business structured? So here I've got an example that we see right here. We've got the Ingram Ranch, and there are two divisions. There's a livestock division and there's also a farming division. In the livestock division, I've got a cow-calf enterprise and a stocker enterprise. And in the farming division, I've got a crop enterprise. Just think that I've got hay there. So we've got some terms here I want to make sure you kind of understand. One is overheads. The overhead costs are costs that don't change as units of production change. Sometimes they're referred to as fixed costs, but they're not fixed because we can impact those overhead costs. And in the Ranching for Profit School, the two predominant types of overhead costs, your major ones, are going to be with land and labor. Then if we go down here on our direct costs, those are costs that will change directly as units of production change. So for example, if I've got one head, then I need 1X vaccine. If I have two head, I need 2X vaccine, that type of a thing. Typical direct costs will be feed and supplement, vet, and marketing, and probably your number one direct cost will be feed. I've also got, if you look here, divisional overhead costs, and those are going to be overhead costs that are going to be there as long as a division exists, but if the division no longer exists, they will go away. So what we can do from there is we can begin to organize things. So rather than just having this laundry list of income minus expenses, we can begin to develop a profit and loss statement. So what we have here is we've got all of our enterprises in the livestock division and our enterprises in the farm division. And from there, we can calculate our gross product, the value of what we produce. Before we do that, we'll note the number of units we've got in each enterprise. And I would really strongly suggest using a standard animal unit instead of a head for your number of units, because say a cow calf might be a 1.4, whereas that stocker might be a 0.8. So it'd give you a greater accuracy there. Also on the farming end, that would be on a per acre basis, or perhaps that would be on a per ton basis. So we have our gross product, and then we're going to subtract out our direct costs. And those are going to be costs that change directly as units of production increase. And what that's going to leave us with is that's going to leave us with gross margin. So we started out with a larger amount under gross product. We subtracted out the direct costs, and what we have left there is the gross margin. So I've got a gross margin for every one of these enterprises. The other thing is, by then having these units here, I can take the gross margin, divide that by the number of units, and that'll give me a gross margin per standard animal unit. So I can compare that gross margin from the cow-calf enterprise to the stocker enterprise to the custom graze enterprise on a per head basis, and also on a per acre or per ton basis there on the hay. Then we're going to add in another section here to give us a complete profit and loss statement at what we have here. So what we're going to get into now is I can add up all three of those to give me the livestock division gross margin: cow, calf, stocker, and custom graze. And then I've got my farming division. And then I've got my two divisional overheads in there. And then I can look at the division gross margin divided minus the division overheads to give my livestock division profit and loss, my farm division profit and loss, and add those both together to get the entire divisional, the business profit and loss from the livestock and farm divisions. Then from there, I will be subtracting out our business overheads, and that's kind of the cost of keeping the doors open and the lights on, at least the cash part of those business overheads. So I'll subtract those, and that's kind of where you're going to be including your opportunity rent and unpaid labor and depreciation, your non-cash costs. And so the division profit and loss from both of those divisions minus the business overheads is going to give me my operating profit and loss. Then from there, if I have some other income, maybe there's another side hustle, maybe there's some money coming in on something else, I'll add that in, and then that will give me my business profit and loss as well. So let's try to put these to some numbers here. So here I've got 300 cows, I've got 200 stockers, I've got 100 cows on a custom graze, and then I've got 1,000 acres in hay. And here you can see that each one of these has their own gross product and their own direct costs. And I can subtract the gross product minus the direct cost to get the 195,000 gross margin here on cow calf, and do the same on all of these. And I can also then break that down on a per unit basis. So my gross margin per SAU with my cows was 650. It was 210 with my stockers and 254 on the cows, and 300 per acre on the hay. So I can add all these three margins together. So the livestock division gross margin is 262,420, and it's 300,000 on the hay enterprise. From there, I can subtract the divisional overheads. It's 10,000 on the livestock, but it's also 200,000 on the farming. I've got to have some equipment, specialized equipment, to get all that farming done. And I come down here to my divisional profit and loss for the cattle division and for the farm division. I add those together. I'm at 352,400. And then my overheads are at 380,000. And so I've got an operating profit and loss of 27,400. I don't have any other income coming in again, so my business profit and loss is a minus 27,400. Again, want to look at that this is a economic analysis, so I've got those non-cash costs in there. It could be, if you roll those back out, you might be eking out a small profit, but it's the kind of thing where you've got a business where maybe you're barely surviving, whereas if we put in those non-cash costs, it pushes us to another level of our thinking. And we'll go on to here. So again, our overhead costs are costs that don't increase as the units of production increase, and our gross margin is what we have there on gross product minus direct costs and increase. So what we're doing right now is we're looking at what are the three secrets. So first of these is decrease overheads. That's the first thing that we can do. The second thing we can do is we can increase gross margin per unit. And then the third thing that we can do is we can increase turnover. And the idea around increasing turnover is could we increase the numbers without increasing labor or land costs? That's where we can get things going with the business. But we've got to be sure that the gross margins are positive. Because if we had a negative 650 here, and we tried to increase the cow-calf enterprise, we would just go broke faster. So decrease overheads, increase gross margin per unit, and increase turnover are our three secrets for increasing profitability. Let's look at the difference between economics and finance. Economics answers the questions, is it profitable? Should I do it? It's the engine of the business. The other side of that is the finance. That's the cash flow. That says, can I do it? In other words, it might be a great opportunity, but how am I going to pay for it? And finance is the fuel for that business engine to run. That's what allows it to run. So that's how they are interrelated, but they are separate. So here might be an example cash flow that you might be looking at. So we go along here, I go from January to July, I have no money coming in at all. So I've got expenses that I got to pay out. I have no income coming in. So I'm running in the red for about 7 months here. And then all of a sudden I get to August and I get some money is starting to come in. And that money is, I'm showing a little bit of a plus on that. And then the next thing is in September, I'm getting more money coming in. So that's looking a little better. And then finally, a lot of my money is coming in October and November. And then again in December, no money's coming in. So I may be flush with cash in November, but then 8 months later in July, I might be living like a pauper because the money has not come in and I've just had all this stuff go out. So it could be one of the things I might be looking at strategically on what do I want to do would be to, can I find a way to start to generate some money either in this April, May, June, July period, even if it's just some money that can help ease the financial stress that I'm feeling during this period of time. That might be a big emphasis for me. Now, as we've gone through all of this and talking about all this economic and financial analysis stuff, if you find yourself feeling like this lady or this guy, let me just suggest to you, you are not alone, okay? Lots of people can get intimidated by numbers, or it's just what they want to do is they want to get out on the land and be doing stuff, and this is just driving them crazy. Well, it's important to understand there's a couple of terms through ranching for profit, working in the business and working on the business. Working in the business, that's all the day-to-day tasks that you need to get done for the business to function. And if you want to talk about working in the business from the standpoint of economics and finance, well, that's going to be filling out the profit and loss, filling out the balance sheet, filling out the benchmarks and doing all of that, all right? And then if we want to talk about working on the business, it's taking those reports and now you're spending time looking at them. You're analyzing those reports. You're maybe tweaking those reports. And based on that, you're making some decisions, or maybe you're also doing some replanning. So I want to introduce you into a different kind of concept. You can listen to this book on Audible if you want to. You could also read it. And that's who, not how. And I want to start communicating to you, you don't have to do it all. There may be a who can accomplish this part right here. So there's companies, here's a couple of companies here. It's not so much that I'm recommending them. I'm just letting you know there are companies out there that can help you in getting this stuff filled out, or maybe you work with your bookkeeper and or accountant to switch from just providing you tax reports to instead actually providing these types of reports with those non-cash costs in there so you can get a better understanding of what's going on in your business. So it could be that if you don't want to do that, you can find somebody else who can do that for you. Now, Jared was just kind of talking about this and that, change involves, and what that's is kind of what you're really looking at. If you're going to the school that Jared and Selena are talking about, you're going to the Ranching for Profit school, you're going somewhere else, you're probably looking at needing a new paradigm. And so what is a paradigm? Well, there are a set of accepted norms and assumptions that guide our thinking and behavior. And most importantly, they're going to influence how we see things. They're going to set boundaries and guardrails. And then because those boundaries and guardrails exist, they're going to provide us with the rules of behavior that occur inside those boundaries and those guardrails. So it's going to look something like this. The paradigm is how we see things, and how we see things is then going to drive the actions that we do. And those actions that we do are going to look at hopefully providing desired results. But let's just say you didn't get the desired results. Well, what happens a lot of times is that the focus starts to be right here on the actions, okay? And we go in a vicious circle in that we haven't changed how we've seen things. We just keep changing our actions and we're never getting the desired results. When really what we need to do is we need to change the paradigm, how we're seeing things, to allow us to change the actions to get us to those desired results. And so what we're talking about is a change in mindset. And you've heard this a lot, I'm sure, over today and probably yesterday too. So here's what I'm suggesting, that the paradigm becomes, I am a business owner. If you have that kind of a paradigm, that's going to drive certain actions that is going to produce an outcome, in this case, that I've got a profitable regenerative business. So what do those actions look like? Okay. Well, they're going to include things like finalizing or updating your vision, your economic and financial projections by the start of the new year, finalizing the balance sheet by the end of the year, reviewing and updating your economic projections quarterly, using key performance indicators to let you know where you are on things. You're going to make needed adjustments based on that review. Talked about, yeah, I heard Jared was mentioning this, having that outside perspective on your business. If you can have some sort of advisory committee that will look, you'll have different kind of eyes looking inside your business. They will see things that you don't. You want to update your balance sheet mid-year, and you also want to set dates and show up for short business reviews during the busy season. You've still got to do that during the busy season. Another thing, if you're going to be a profitable business, you're going to think of yourself as a business owner, then you need an office and you also need a meeting room. This is critical. If you're trying to work in your house, your kids are there, you're getting interrupted and all those types of things, it's hard to focus. You need an area you can go to where you can focus. If you want some more information on this, go to the Ranching for Profit website. You'll find a link for profit tips on August 27th, 2025, by that Dallas Mount wrote, the owner of the company, creating an effective place to work. And there's also a companion video in that article that you can look at, that you can really look at the importance of having an office. Another thing that needs to be in place is the mission statement. And this is the kind of thing of why we are in business, all right? That we've got that. So you've got to be really clear on the business that you are in. And I think a tool that can really help you with this is this thing called the business model canvas. And a couple of things on this canvas here, if you look on over here, you've got the customer segments. So those are the different customers that you have. And then you come over here to this value proposition. Now, there's a lot of questions in there, but I think the thing that really became apparent to me this summer is breaking it down to its essential components. So there's the value proposition. So based on each one of these customer segments, what is the problem or what is the need that needs solving, and how are you going to solve it? So what are you going to do for them? That's how that defines that. So if you keep that to the forefront, from there, it's just, how are you going to be relating to the customer? Is that going to be personal visits? Is that mainly going to be electronic kind of thing? How are they going to know about you? How are you going to fulfill what they are needing, or the problem, or solving the problem? What resources do you bring to being able to do that? And what are the key activities you conduct? And what are the partners that you need? And then what are the metrics on both costs and revenues that you need there? So in addition to the mission, once you know what your business is and why you're in business, Now you can get to the vision statement. That's where you're looking to the future. Okay, you've got to know why you're in business first and then create that vision statement. So, for example, where do you want to be in the business in 5 years? If you want to do it in 3 years or 2 years or whatever you want to do, you can do that. What are the enterprises? What do they look like? How is the land managed? How is the business structured? Who are the people in the business? How do the people in the business communicate? Those types of things. The other thing is developing a profit target. And in order for you to develop a profit target, you need to define what is profit for. And I ended up coming up here in this example with a profit target of 100,000. But the only way that I got to that is I started to think about, if I generated profit, what would be the ideal profit I'd want to generate, at least starting out? I may be thinking too small even here, but what are the things I would do with it? Well, you can see I want to pay down debt. I want to reinvest in the business. I want to do charitable donations. So I want to give back to my community. And then I want to have some sort of bonus structure. That's bonus that would be available for me to give to employees. Maybe it could be in the form of a dividend to me as a business owner. So as you can see, that's 40,000 to pay down the debt, 30,000 to reinvest in the business, 10,000 for charitable donations, and that 20,000 bonus got me to 100,000. You've got to define your own personal profit target, but it's meaningless unless you know what that profit is going to be for, at least from my perspective. Now, the other thing we got to talk about is organization chart. So this is Jim right here. I worked in California for like 31 years and as an extension agent, knew Jim for like probably 37 years or so. And he started a direct to consumer meat business in about 2006. And this is Jim's org chart. He was the CEO, COO, and CFO. So he was a C-suite guy. He was also the vice president of production. He had a lady that sort of helped him some on marketing, Kathy, and then Susan kind of kept up with the money and gave him financial reports and also kind of handled whatever human resource issues there were. There was an irrigator that worked in the summer, and then sometimes there was some part-time or daytime help. If any of this looks familiar to you, okay, I want to suggest to you that it's taking unsustainable effort to keep this business going. Now, we've all are going to start out this way, that, we've just got to sacrifice and do all that we can. But at some point in time, the business has got to get built to where it's not so reliant on you as an individual. Otherwise, your potential for burnout is really going to be high. And then there's also just going to be limited time for you to get to some of these other bigger pictures, that economic planning, making big decisions, and those types of things. The other thing that happens in this situation, especially with Jim, maybe you can relate, is the systems were all in his head. And he never could figure out how he could get those systems out of his head. And that's one of the things on this who, not how again. I mean, you could literally just pay somebody to spend 1 or 2 hours with you, and you could just verbally say what your systems are for, say, weaning cattle or whatever is the big production stuff, and they could write that down for you, that you could then be the start of some SOPs for you that you could just continue to evaluate each time you went through weaning, for example, and you could be fine tuning what needs to be added or deleted. Or just even the fact that you can take your phone and you could speak into the phone and speak your system right into the phone, and then that would transcribe it into a written thing. So that's some things to be thinking about on that. So then if you want to try and quit staying in that quagmire, then I think it's important to understand. I mean, you've got an organization chart, but really getting clear in your mind also on who do you need to hire. In Jim's case, I think it would have been really helpful if he could have found what I'm calling like a journeyman. This would be an experienced person who can execute daily tasks and are competent to execute given tasks with minimal training or supervision. And you can just meet with them and they can go out and get the job done. And so if they're experienced, there's a shorter training period with less direct supervision. That's where that's going to give you a little bit more time to develop systems, and then you're hiring people to implement those systems. And if you can't get somebody experienced, and maybe somebody who's an entry-level person or an H2A person, is showing some aptitude for picking things up and are interested in what's going on, and maybe within 6 months or a year, they can get to more of this experience level. Or do you need a foreman? That's going to be a person that you can meet with on what is all the daily stuff that needs to happen. But then if they've got other people, or that even them as an individual, that they can go up their game as to a foreman type level of just understanding what's needing to be done and getting that work done. That will give you some increased time to focus on the working on the business stuff and start to free up time for you to start thinking about how can I grow that business? Or is it just simply having a manager that maybe you've got somebody who's really, really competent that you can turn over some aspect of, say, the cattle production, and that's their total responsibility. And then they will make sure that all that stuff sort of happens. That will really jumpstart your increased time on working on the business and give you even more time on how to be able to grow the business as well. Another thing is that if I've got the office, the other thing that you've got to do is you've got to commit to showing up for the working on the business on a weekly basis. And the book that I also want to recommend, that again, you can either listen to on Audible or you can also read, is a book called Atomic Habits by James Clear. And that can give you a really good way of starting to build habits by setting some low bars to achieve, to help you develop that habit. And then over time, you begin to increase the time that you're spending on that. And one of the things you might want to think about, I showed some cash flow earlier. You might want to look at time flow and what you want to do on your working on the business. And you could track that on a monthly basis. Here, as you can see, in January, February, and March, every week I want to spend 8 hours on working on the business. Now, that didn't mean you're spending your whole day working on the business. That's maybe a couple of mornings, or a little bit in the morning, a little bit in the afternoon, or whatever that works for you. And then the rest of the week, you're outside doing stuff and helping out and all the other things that you've got to get done. April and May, I started to cut that down to 6 hours a week. And then as I get to the busy season, June, July, and August, I'm saying right there, well, that would be about 4 hours a week. But it does mean you're going to carve out that time to be able to get that work done on about half the time that you would be spending in January and February. I'd start to ramp it up again in September, and then October, November, and December, because I want to get my more planning done. I'm going to ramp that up to 8 hours a week. You could figure out what that needs to be for you, but this would be a potential way to sort of lay that stuff out. So here is our current situation that we saw earlier. Here we've got everything is organized by enterprise and by division. And we're back here, we're looking at our $27,400 loss. Well, the first secret is to look at decreasing overheads. Again, overhead costs are costs that don't increase as units of production increase, and then increasing gross margin per unit, and then increasing turnover. And so what I did is that I was able to take that $380,000 in business overheads, and I was able to get that cut down $30,000 to $350,000. So how did I do that? I figured out that I could get rid of $100,000 in machinery. What they've done through Ranching for Profit is they kind of are looking at that. If you look at depreciation, repair, maintenance, all the other stuff on equipment and machinery, it's typically 25%. So by getting rid of $100,000 of machinery, I got rid of 25% of my overhead. So that was 25,000. And then the other 5,000, I found some other ways to get that down. So by reducing the overheads by $30,000, I've now got profitability of $2,400, but I just barely got a nose above the water. Any kind of hiccup and I'm going to be under the water again, but at least that's phase one of getting some stuff done. So now that I have this template, I can start looking at stuff. So the thing is, I've decreased the overheads. All my gross margins are positive on the livestock side. So what if I increase turnover? And I said, what if I increased it by 30% for each one of these enterprises? And I can do that without needing extra labor or land costs. So I'm now up to 390 cows, 260 stockers, and 130 custom grazed cows, which I feel like the market is there where I can get that. But the thing is, it's going to be the high cost of cows. Right now, I plugged in 3,000. I'm sure you'd come up with a different value. But even at $3,000, that would be $270,000 of capital for me to move forward with that. So is that going to be the most prudent thing that I want to do? And at least in my case, I'm not sure that that's what I want to do. So I want to keep looking. And again, this is an example of what you can be doing in the office with your Wattbee, kind of doing things such as this. So instead, I took all of that 30% increase and I put it to the stockers. So let's go back a minute here. When I was having it across the board, you can see that I ended up with an $81,000 operating profit and loss. My division profit and loss jumped to 341,146 with the livestock, which gives me the 431,146 there. If I go to the stockers, I ended up with 428 units that was there. Now, that got me to a profit of 50,300, but my profit target is 100,000. So that's a lot better than $2,400, but I'm not quite where I want to be with there. So I'm going to keep going. So what if I maxed out on the custom grazing of the cows? Well, I dropped down a little bit. I have about $41,000 in operating profit and loss, and I still want $100,000 that's there. So again, that was a decrease overheads and also increasing the turnover without extra labor and land costs. So then I looked at, well, what if I put that 30% increase to the stockers and also the custom graze? Well, it's a little bit better than just doing the custom graze, but it doesn't beat doing stockers only because I got about $45,000 worth of profit. So anywhere from $41,000 to $50,000 worth of profit if I increase stockers alone, custom graze alone, or stockers and custom graze together, and I'm still short of my profit target. Again, $40,000 worth of profit, that's great, but can we keep pushing ourselves? And there's our three secrets again. All right, let's see what we did there. Okay, so now the next thing that I looked at is instead of custom grazing cows, I started thinking about, well, what if I leased cows? So I was talking with a rancher at an EL meeting in February, and he actually started ranching. This would be in the early 2000s by leasing cows. And he sort of built his ranch on leasing cows and then began to evolve from there and had made the point that when cattle prices are high, leasing cows might be an option to look at. I'm not saying this is what you need to do, but we're trying to think outside the box here. So I still kept the stockers at 260 units, but I am going to lease 220 cows. And so what I ended up doing is that gave me almost $114,000 in margin. And so what is happening in a situation like that is that because I'm leasing those cows, and this would be on a 70-30 basis. So I'm keeping 70% of the calves, the owner is 30% of the calves. And so that is allowing me to increase production, okay, because gross product is price and production. And I'm doing more calves, which are going to be worth more than those custom grazed cows. So I'm increasing the returns that I'm getting from there. So by doing the leased cows, that actually allowed me to hit the profit target by also increasing the stockers as well at 103,340. These numbers are all arbitrary, but it's just, this is, once you get your template set, you can start looking at different ways to do stuff. And then you can look at what is the, how is that going to be turning out? We'll do that. And the same way on the stockers. So if I could look at there, is there a way for me to, for example, improve gross product? All right. And that would either be price or production, or is there a way for me to say decrease direct costs? But we got to be careful on the direct cost side that we're not trying to starve a profit into the business. So then, and I know that Doug Ferguson is following me after this. So maybe instead of just thinking at it as a static stocker enterprise, then maybe what I need to do is I need to look at a sell buy type of a operation, and I need to find out more information on there. Maybe my education for the next 6 months is going to be finding out more on that thing. So this type of moving and looking at different ways to improve profitability can lead you to maybe some next steps that you need to be doing. All right, so thing I want to emphasize here is, what do I need to be doing? You need to invest money in things that are going to be producing cash flow. Here are just some examples that I came up with. I'm sure you can come up with many more than this. Custom grazing, stockers, developing heifers, taking dry females to bred females, short bred females to heavy bred females, doing sell by, leasing cows, buying animals and converting them to meat. The things that you don't want to do, and you've really got to watch, is investing money in things that do not generate cash flow. One of these is monuments to tax avoidance. So David Cole kind of hit on that, of saving, 20 cents, and what all he was saying there. In other words, don't buy something just to avoid taxes, or maybe buying machinery you're only going to use only occasionally. Or some things that I ran into with a business over the last year and a half is hiring more labor, trying to anticipate growth before it has occurred, buying equipment before that anticipated growth has occurred, and also investing in land improvements, predominantly pipe and fence, when you don't have a long-term lease, and then all of a sudden, 3 months later, you find out that they decided to terminate the lease because they're going in a different direction. So really thinking about, if I have money, so that was like that $270,000 that it would take to buy 90 cows at $3,000 a cow. Is that the best way to generate cash flow, or is there another way, if I was going to take that money, that could be generating cash flow on a more current basis type of a thing? This person who had hired more labor in anticipation of growth, both labor and equipment in anticipation of growth, he was relating to me that if he had to do it over again, he would have focused here, buying animals and converting them to meat, because he could do that and have that animal have money coming back in 6 weeks type of a thing. So always keep that to the forefront. Also, as far as if I'm going to do something different, there's tools available to dig deeper into trying to make that decision. Let's say you wanted to go into developing heifers, doing a business model canvas, which is a great way to really explode that out on what that's kind of looking like. Again, this is the why we are in business and how we're going to be doing that. And what happened with this thing is the breeding heifers, the gross margin per unit was high. The ranch was in a multi-year drought. They were already needing to reduce numbers. They knew they had to go into a different direction. It didn't mean they eliminated the cow-calf enterprise, but it became much smaller. And by focusing on this profit driver of gross margin per unit high, they were able to switch to developing heifers and made the ranch more efficient, profitable, flexible, and decision-making was easier. And everybody was on the same page. And every team member knows the goal and how to get there. Then another way that you could look at that would be through a SWOT analysis. So you could look at the strengths and weaknesses and the opportunities and the threats. Our opportunities and threats are external to the business. Our strengths and weaknesses are internal to the business. So for example, this would be taking cull cows and breeding them and selling them. So I could circle the ones that were my biggest strengths and my biggest weaknesses, my biggest opportunities and my biggest threats, to figure out are there ways to maximize strengths and opportunities and minimize weaknesses and threats. Another way that we could do that is there's a guy named Edward de Bono who came up with a book called The Six Thinking Hats, and we can actually use that to help explore an idea. So we can use the white hat to talk about what are the facts currently on the ranch, and then there would be the proposal on the green hat. So that would be taking cull cows, breeding and selling them. What's the upside of doing that? That's the yellow hat. And then we've got the black hat. What's the downside? Notice the black hat does not, the upside occurs before we get the downside. We don't start with the downside. Too often that's where we go first. Then we come back and we wear the green hat again on how can we improve the upside and minimize the downside. And after we go through all that, how are we feeling? Do we want to move forward? Do we not want to move forward? Another thing that we can do is we could use a pro and con. So what are the pros? doing a cold cow breed and sell enterprise and do it that way. I added, you could look at, is it regenerative or not? You could rate it that way. And here's the criteria on the cons. And we can score those on a +1 to +10 or a -1 to -10, or you could use whatever scale that you wanted to. Another thing that you could look at is you could look, if you wanted to evaluate different enterprises on which one should I do, you could actually do what we call a decision grid. So here are different criterias that are right here, and we can score by enterprise. Here I've got, selling bred cull cows here, selling cull cows and stockers, and then just staying as is. What does all that look like? Now, these numbers are subjective down here, but maybe it gives you an indicator of maybe some things that you need to do a deeper dive on. And I can also weight some of these more important. So like profit, I scored it as a 10. We can score it from +10 to -10, but because I've weighted it ×3, then I'll multiply by ×3. So I'm just letting you know there's different sort of processes that you can use to be able to figure out maybe what's the best way to go. When I think about maybe the last 4 or 5 years, it used to be if I wanted to look at a podcast, well, there'd be the Working Cows podcast. That's typically where I knew about. And then the Ranchonomics podcast sort of started. And then all of a sudden, it's like they've just proliferated and exploded probably over the last 2 to 3 years. I know Doug Ferguson, he's speaking next. If you do a search of Doug Ferguson podcast, you'll come up with like 10 different options type of a thing. And then we also have artificial intelligence as well. That's another thing. So there's just all this stuff that is out there on an unprecedented level. And that got me to thinking about this, and that is not succumbing to paralysis by analysis. You're going to spend so much time analyzing options and potential good things or bad things that can happen, that you delay decisions, or you never even make it because you're just afraid of making the wrong choice. And so I just want to point that out as something to be sensitive to. And then there's like this, I listened to this guy on YouTube, and then I get this weekly email from him. And I got an email on October the 16th, and he made these key points, is that most people don't need more information. They need direction. They're drowning in podcast videos and advice, and yet they're still spinning their wheels. So I want you to keep that in mind. And also this week, Paula Ploshik Jones, she's my cousin. She's in real estate. She posted this, and I thought this would be good to pass along as well. Here's my biggest takeaway after 60 years on the planet. There is great value in being fearless. For too much of my life, I was too afraid, too frightened by it all. That fear is one of my biggest regrets. And I just wanted to pass that on because I would concur with her. We've got to overcome our fears. We've got to define that direction, and we've got to move forward. So here we've got our profitability pathway that we can see right here. And some things that we can get sidetracked because we could get, we're just in the busy time of the year. Maybe there's family obligations we've got to take care of. Maybe there are unexpected events. Maybe there's a health crisis that's occurred, or an unexpected death, or whatever. Or maybe we're easily distracted by seeing new business opportunities, and it gets us off the path. So how do we get back on the path? Well, again, I want to stress this Atomic Habits by James Clear. Again, you can listen to this, or you can read it, whichever one that works. And I talk about this concept of setting a low bar. So to get back on that profitability pathway, don't beat yourself up, okay? Just picking it a day at a time, you're going to show up in the office. And once you've done that, that means you are showing up there, and show up at that time. And he's got the 2-minute rule. Before showing up, decide what you'll do for 2 minutes. Maybe you'll just go in the office, you'll review your cash flow, maybe you'll watch a YouTube video, listen to a quick podcast, or you'll do something else. And then after 2 minutes, you're going to leave there. Now that may sound insane, but the thing is, you're going to keep repeating that process, and you'll keep repeating it until you get to the point that, well, if I've gone to all the trouble to get here, I might as well start doing some stuff. And you begin to develop of showing up at the office and then staying focused and getting things done, because you'll determine that you are going to get stuff done and you're going to keep showing up. Now, let's review. So the first steps on the profitability pathway. We need a change in mindset, which means a change in the paradigm. You pick the paradigm you want. I'm picking, I want to be a profitable business owner, and I'm not going to be one who says I got to do it all. So that whole concept of who, not how, I'll find other people to help me get stuff done. I'm going to have an office and a meeting room, and I'm going to have weekly office hours. I'm going to have a mission statement and I'm going to be very clear on why I am in business. And I'm also going to have a concurrent vision statement that I'll be revisiting annually or even more than that, as far as in my case, where do I want the business to be in 5 years? And I'm going to have a profit target that is based on what is profit for. Okay. And remember this, that if you are in a situation where the business is in crisis, losing lots of money, fix the economics and finance first, but then you're going to have to get right back into here. So we're still on that pathway. We've got to figure out what's the structure of our business. We need, what is the organization chart? If I've got an organization chart, I'm going to need some position agreements that are going to have the results I want produced, as well as targets on there. How is the business going to be communicating? I need to know what's the current business status, the profit and loss, the cash flow, the balance sheet. And based on that current business status, what do we need to stop doing and what do we need to start doing? And finally, that's going to mean that you're going to need to make needed decisions and then go ahead and implement them. And that's where you've got to overcome fear or uncertainty and have the confidence of moving forward and know that you can adjust to what you need to do. Now, I listened to David Cole, and I know Selena was kind of bringing this up too. And I took a lot of screenshots of his slides just because I'm going to have to listen and marry up what he was talking about with those screenshots to better understand what was going on. But I wanted to pass this on. I did a search, and he mentioned this, that you can find this online. So I searched management mindset, David Cole. And there is a website, he talked about this TPAP program through Texas A&M. It's at that website. This is kind of a long thing to do, but if you'll search here, that link will come up. And this is a PDF that is 2 sheets is what it is. And there also is on Ranchonomics, episode 58, David Cole is on there talking about that management mindset. And then also just a reminder that there's a second page here as well, which I think just dovetails on all the stuff we're hearing today. What do we need to continue? What do we need to improve? And what do we need to stop doing? That concludes what I wanted to talk about for today. If you want to call me, you can call me at that number, and there's my email address as well. I'd encourage you to take advantage of the efforts there that Jared and Selena are talking about, and also check out the Ranching for Profit School. There's the website, and there's
Mm-hmm.
the phone number. So that's it.
Mm-hmm. Perfect. Perfect. Good timing, Roger. We appreciate you being on this class today. You bring a wealth of knowledge and experience, and I'd ask this question of others, but I'd love to give your take on it. What do the truly successful ranchers have in common in the ranching for profit? They call those their benchmark businesses, the ones that are maybe the outliers that are profitable more years than not or every year. What are some of the things they have in common? You covered a lot of them probably in the presentation, right? But anything else that stands out?
I think one thing is when they saw that new direction, they had the courage to move forward on that new direction. And I think the other thing is that especially through that executive link program, which sort of gives you a more formalized advisory board, that other businesses pushing each other really pushes them to look in different directions and get new ideas on what's going on. And also just, I think, always just thinking ahead and looking at what are the new opportunities that are out there, I think would be some consistent things, along with that they've got their economic analysis done. They know where they're sitting as a business. They stay up with their projections. They stay up with updating their projections. And, for example, there was a challenge with some businesses on one board that in August they were getting weekly margin calls. And so huge amounts of money were,
Hmm.
but still they already knew that even with that money going out, it can tend to seem like the sky is falling, but they knew looking at the economic analysis that they were still in good shape. So it helped ground.
Yeah.
I think the other thing I didn't put in here, but just wanted to mention, because I know David Cole what I seem to think I remember him saying is that don't let your self-worth be tied up into your net worth, for example, on your balance
Yeah.
sheet. Because if you look at the rise in the cattle prices, it wouldn't surprise me that a lot of businesses, their net worth has climbed by maybe 20% or something like that,
Oh, yeah.
just through what market forces are doing. And then if there's a sudden downturn, my sense is what all you're going to hear is the sky is falling, but it's actually just the natural process of that decreasing. And so again, in a falling market, where are those opportunities? There may be that first initial trade where you ended up buying at the high market and now it's starting to fall. That's not going to work out great, but you'll just do a reset on how to deal with that falling market. And I think with Doug coming on after this, that's going to give you some other tools on how to deal with whether it's a rising market or a falling market or a static market or whatever. It's just you're just starting to look at it's just what the market is and how do I need to respond to that type of a thing.
Yeah. Yeah. Very good. Well, yeah, that's a good segue into what Doug Ferguson is going to be talking about next. But this is kind of a random question. You've seen a lot of businesses and you've seen, behind the scenes because of the nature of the consulting role that you've been in. Do you have an estimate like for at scale ranches, how many of them are utilizing debt as a tool versus how many are self-financed and do not have debt? I guess to simplify that, what percentage of businesses would not have any debt outside debt?
Very small percentage. I would
Hmm.
say, when I was talking about those businesses who've really moved forward, they have used debt strategically to help move their business forward. And
Hmm.
they have done. So they have needed debt as a tool to focus on stuff that's producing cash flow to help them get to a bigger scale type of a thing.
Yeah. Yeah. And the key word there is a tool, right? Not a crutch.
That's right.
Um,
That's
but
right.
literally,
They're not a
literally.
bailout, but it's just there's a plan to profitability, and I'm going to need some extra money coming in to help me get to there. But I'm going to be able to service that debt and also generate a profit out of that type of a thing.
Yeah. Very good. Well, Roger, thank you so much for being part of this group. We're honored that you would join us and appreciate the perspective. And those are, I mean, they're absolutely sound principles. You guys adhere to them, and the results will follow. So be blessed, Roger. Thanks again, and hope we'll have you on again soon.